Once again, welcome to our first FWU investment webinar in this form. I would ask all of you to kindly mute, which is to the comfort to your good self and also everyone else participating. I would also like to wish all of you a belated Happy New Year. I hope you recharged those batteries the last year and you and your loved ones had some beautiful days. Today is a step for us because from FWU side, we're looking back at a year of achievements and those we want to share with you. But even more, we felt as we at the moment cannot meet you in training sessions, on roadshows, or just in your offices. It is even to come to your home in a virtual way. And that's why we are very excited to have this meeting here also in your local languages. In that context, in the middle of the bottom menu, you can select your language. We have French, Spanish, Italian, Flemish, German, and English. Please do choose your language. Perfect. So please do let us know if there are any topics and write in the chat. Also, if there's questions, then please do put these into the chat. A couple of familiar faces. Maybe I'm not a familiar face to all of you. I'm the Chief Commercial Officer of FWU. My role ultimately at FWU is to support the local teams around our general managers, Antonio, Pedro, and David, to be a support for you in your customers' conversations, both existing customers as well as potential new customers. I also take care of the marketing and communication at FWU, and I'm a board member to FWU LifeLux, taking care of our administrations. Therefore, it's really a great pleasure to welcome all of you today. I would like to thank both the translation team as well as the team making this webinar possible for this occurrence, because this is, as I said, such an important point as we cannot meet as we wanted to share with you some insights and also to create additional trust, because the trust that you have in our products, in our funds, in our solutions is ultimately the most important currency that we have. In this context, I would like to point out that I think at the last year, it might have been easy to score good performances. However, it is not only good enough to score a good performance once in the contract duration, but our job is to share with you how did we come to these decisions. What were the opportunities that we missed? Because we don't have a problem with telling you the opportunities that we missed, because we actually nailed much more opportunities than we missed. So this is why it's a great pleasure to introduce two significant gentlemen. On the one hand, Michael Graham-Matson, who will be addressing you and walk you through last year's performance. And in the course of this webinar, which we will have occurring, you'll also meet a very valuable colleague of mine, Mr. Nicolas Flaty, who will also address you in this format. So please do join me in the enthusiasm welcoming Michael Graham-Matson. Over to you. And please do let us know if you have any technical topics or the translation is not working. I was asked by my team, those of you who don't have a good quality, maybe turn off the video also. This, I think, is helpful for you guys in the way you're receiving the webinar. So thank you again for your trust. We hope to build it even further with this event. And I hope to see some and most of you very soon. Thank you very much and see you around.
Thank you, Alex, and let me take over from here. And thank you to everybody for joining. I'm really enthusiastic about how many people have joined this first webinar for FWU. It is hopefully going to be a great thing going forward. And if I can just repeat what Alex said, would you please mute your microphones, because it is somewhat annoying to have people talking in the background when we're presenting. Anyway, I'm Mike Madsen. I'm the CEO of FWU Invest in Luxembourg, and I will be taking you through this first webinar. And for the following many webinars, it will be my colleague Nicholas Flaherty who will take care of you. Now, I will share my screen and we can move forward to this first webinar. So I hope you're all seeing it. This first webinar, like Alex said, is going to be all about 2021. What happened? Why did it happen? How did we do? And then we'll finish off about how do we see 2022 evolving? It's already a little bit in the beginning, and there's a lot of interesting stuff to cover also in 2022. We will, though, start off with a little message from our legal department. We have to do this, a disclaimer saying that we're not trying to sell you anything, and anything we say here is, of course, not a guarantee. So please be aware of that. All right, let's dig in. The 4 topics, or the 4 questions, if you will, that we will deal with in this next 20 minutes is, firstly, how was 2021 for the investor, in particular the equity investor? Where were the best parts of the market? How did we do in FWU, especially our forward quant products? And then as the 4th and final point, like I said, we will dig into 2022. How does the next 12 months look when we try to look into the crystal ball? All right, so 2021. Well, you probably all know the answer to this particular question. It was a very good year, especially for the equity investor. This particular chart is the MSCI World, and as you see, it was pretty much up all the way. A few small drawdowns here and there, but nothing major, nothing certainly like we saw in 2020, where we had the whole COVID thing come in. But this was probably also why we had such a good 2020 that is, because coming out of the back of this massive uncertainty that really hit the markets during the first part of 2020 also meant that we started getting less and less uncertainty into 2021. The one big thing that really helped us was vaccines. You may recall in November of 2020, the vaccines had their emergency approval and we started vaccinating people early 2021. And as that progressed, and also as we kind of became used to the whole COVID thing, the uncertainty surrounding COVID, the uncertainty surrounding what happens when we're in lockdown, how does that affect us? How does that affect the economy? Became less and less. And now most of us, those who can be vaccinated, are vaccinated once, twice, 3 times, 4 times some even. And we are having somewhat more optimism towards the future of COVID. So that certainly helped us going into 2021, and especially here in the developed world. But COVID had one more very big effect economically, and that was the amount of money that was tossed by governments into the market and into the economy itself. Now, if you look at the chart on your right, the dark little bar there shows you how big a part of the global economy governments used during the financial recession of 2007 to 9, the amount of money that they spat into the economy to really safeguard it, roughly about 6%. And that was a lot back at the time. But to the left of that is the amount of money that's been used to safeguard the economy during COVID. Almost 30% of the entire GDP has been put into the economy in order to boost it and safeguard it from more collapse. And it's worked. We know, pretty much all of us, I'm sure, know some small business owner who could have had it a lot worse than they had it not been for various aids for the government. And many of these things went really well, and the markets liked it. I mean, they saw that this was reducing uncertainty, and uncertainty is the big bad wolf when you talk about investing. You want as little of it as possible. They liked it, and it was really stimulating the economy. And it has been a very big driver in 2021. But I think the ultimate driver in 2021, which has been the ultimate driver maybe for the last decade, is the monetary part and positive monetary environment. What do we mean by that? What we mean by that is that the central banks of the world, and we're talking about pretty much the entire world, for the last 10, 12 years, have been using their balance sheets to buy bonds. They've been using their balance sheets also to reduce rates significantly. And as you see on the chart there, it was already climbing quite significant since 2010. But what happened in 20 was above and beyond. This whole program of quantitative easing just really got a big boost as well again. And what happens when you have these low, or here in Europe, most often also negative interest rates? What it means is that, first of all, it's very cheap to borrow money, goes without saying. That, of course, means that you have more money to consume, which is a great thing. But what it also means from a more technical point of view when you're an investor is that, well, you don't really want to invest in bonds where you're guaranteed to have a negative return, right? I mean, it's not in anyone's interest. So what do? Well, it means you move your risk profile a little bit. You move it towards equities, or maybe the defensive part of the equity side. And that's what people are doing. It's called crowding out. And it means that having such a poor environment in terms of interest rates as an investor means that money is being pushed into the equity markets. And that has really driven why we have such amazing returns over the last 10 years and why we had such great returns in 2021 as well. So that's kind of the foundation of what really drove markets across the world during 2021. COVID was kind of on the back burner. We had it under control. Money was being thrown at us from the governments of the world, and we had negative to zero interest rates all over the place. But there were differences. Depending on where you invested, there were differences, and there were reasons why there were these differences. Now, the leader, you would almost say as usual, because it has been the case for quite a long time, is that the US did the best. The US, in this case, represented by the S&P 500, was pretty much the best market out there of the big ones. They did really, really well. And why is that? Well, the US has one dominating trait that no other index in the world has. Now, obviously, they have a great economy, hands down, but wasn't that much better than Europe. But what they do have in terms of their index is that they have 41% of the S&P 500 dominating is the tech. So you all know them: Apple's, Google's, Netflix, Microsoft's, the big ones, well-known ones. And with work from home really coming into its own, it's just accelerated this whole movement towards the tech companies. It means that not only for the last handful of years have they outperformed, but they again were probably the best big sector to be in during 2021. And of course, when you want tech, well, you go typically to the US. And it's one of the main reasons why US was a leader again in 2021, as they were in 2020 and 2019, also because very much of the tech stocks. So second best, Europe. Europe, you can see it almost up until September did pretty much as well as the US, and only the last 3 months ended up by dividing the two. So also a very, very good year for European equities. Now, the differences between the US and Europe this year was very much in terms of the tech. As you see, Europe has hardly any tech in it. About 8% of the big European stock indices are technology. Most of those are semiconductors and a little bit of software. So not really something to really spur the enthusiasm of tech investors all over the world. What we do have instead is that we have a lot of industry and we have a lot of banks, and they also did quite well during 2021. So really, really well done by European stocks also. So what didn't do so well? emerging markets. The emerging markets, dominated of course by China, India, Brazil, Russia, they really had a bad year. As you see there on the light blue line, they were not just a little bit less up, they were down in 21. That was really, really a bad year compared to what all the other markets were doing. Now, why is that? Well, there are several stories to this. Firstly, of course, COVID. COVID has been much worse in the emerging markets than it has in the developed markets. Vaccines have been very slow to roll out. See it on the right side here, that only about a third of the ones that are being vaccinated in the European and US developed markets have been vaccinated in the emerging markets. It's very slow, we're seeing it. We're also seeing that mutations are coming from South Africa and all these emerging markets. Now that means more uncertainty in these markets, meaning investors from Europe, for instance, are less keen to be there. But what we also saw was that in the biggest emerging market, China, we saw them continuing to crack down on corruption and crack down now also on their tech companies and the companies that they are thinking can be a little bit too big for their otherwise autocratic system. And that meant that the likes of Alibaba and Tencent and so on, who are very much a big part of the Chinese indices, took a big drop during 21. And the last thing that also hampered emerging markets was the dollar. Had a very strong dollar in 21. And typically, a lot of emerging markets have a lot of dollar debt. And when the dollar goes up, so does the debt on these markets. And it has a tendency also to hold back emerging markets when they have good years of dollars. So that was also quite a hamper for the emerging markets. So basically, very good year for equities. Very good year for equities in the US and Europe. Not so much in emerging markets, but if you could get around that, I mean, it has been a very, very strong year for equities around the globe. So how do we do in this case? How did the forward quant products do in this very good year? Well, the answer is we did even better. So what you see here is our dynamic risk control fund doing significantly better, almost 4% better than the benchmark after all fees. It was not the only fund that did well for us. Our FWU funds, which we also have out there, was in the best 1% of all funds in Morningstar, an achievement that we are truly, truly proud of. And we've done this not by taking on excessive risk. We have a little bit more risk than the benchmark this year, but we're well below what we call our volatility control cap, which is somewhat higher. And a volatility of 10% over the last year is also very much in line with where we want to be. So great year overall for equity investors, even better year for those who've been invested in FWU products. And as Alex said, now is also the chance where we get to tell you a little bit about what went right and even more, what went wrong over this course of this year. And just to quickly give you a refresher, the forward quant products and any other FW investment products are all quantitatively driven. We're all driven by AIs, machine learning algorithms that take most of these decisions for us. It is not Nicholas and myself sitting and making decisions on this. This is done by a machine. So when I say we, and I tend to say we sometimes on this, I do mean these are the algorithms. So the right choice, let's do the good things first. The right choices. Well, certainly the major right choice that was done in 21 was really to be overweight equities. We had the models stating that equities would have a good year in 21, and they certainly did. We just saw that. And having much more equities than the benchmark and underweighting both bonds and cash was very much the right place to be. We also, models also did not like emerging market stocks. And as you just saw in the previous slides, that was also the right choice not to be there. We were a little bit, but not much. And again, very, very good choice on that part. We were also with the US, which was also very good. When we look down into the nitty-gritty, looking into which stocks and which sectors we had chosen, we were very much in terms of equities, also in banks. That was also a couple of good choices that we did. And overall, all of these things have kind of made that we've done well throughout the year, throughout the various phases that this year had, because there were many phases within this year. Now, not everything the algos did or that we did were right during 21. So one of the first things we did in the early part of the year, where we were very much in what you would call cyclical companies, so European capital goods firms, automotives, etc. And in the first part of the year, the first half of the year, this was an amazing trade. It really went up, doing really, really well. But as China started cracking down and the growth in China became lower, this also started to lose a little bit of that overweight. And we didn't get out in time. We didn't get out well enough to just take that profit fully on. So we lost a little bit of what otherwise would have been an exceptional profit. Still very much in profit, but not as much as we could have done. And then the energy rally. Now, I'm sure you all seen the gasoline prices at the pump these days. They have gone up quite a bit. I tanked at €2 on the Autobahn not so many days ago. I don't think I've seen it that high for a very, very long time. What that is a symbol of is also the oil price going up quite a bit. And with it, the energy companies out the world. Unfortunately, our models did not see these oil companies as having good quality growth, and being a good quality companies. And so we were only a very small part of the company of our portfolios were invested. And that was probably one of the biggest mistakes that was done this year, is that we were not heavily invested into this energy rally that came up into 2021. But fortunately, and as Alex said, we've made far better and far more good decisions than we had bad decisions. But 2021 is over with. It's done. It's in the history books now. So when we look at 2022, what do we see? So let's look a little bit more fragile. I mean, COVID, well, as you see on the chart, COVID looks to be spiking right now, but you can see good and bad things about that, because Omicron, the dominant variant right now, is not looking that ominous as maybe Delta did. And so maybe this is the one we should all be infected by, and hopefully it'll become less and less deadly as we go along. So maybe it is the beginning to the end. Let's see. Anyway, COVID is not really gone. It's still here. It can still spring to life and give us some uncertainty if we really, really want to. But it's not the real reason why we see a bit of fragility in the very short run. The real fragility is on that big pillar that I mentioned earlier, the one that's really boosted equities for the last decade. And that's the monetary policy and the interest rates. So when you ask the central banks, can we continue to have this low interest rates? Most would have said yes, for a long, long, long time. We can, of course, continue to have very low interest rates because inflation is not peaking. Problem is, as you see on that chart out there, inflation has really come up and it is starting to peak. And how long can the central banks sustain such an expansionary monetary policy? How can they sustain this low interest rate if inflation continues to tick up and up and up? And the answer is probably not for that long. And if the central banks of especially the US and Europe need to take back some of that money that they've been throwing at the monetary market and maybe even have to hike interest rates, then we will see kind of a reversal to what we've seen over the last 10 years of really very, very strong equity-driven rallies and very, very strong tech rallies. Now, how much will this be? We don't know. But we do see a risk that in the short term, we will see at least some volatility. We will see a bit of fragility in the markets. We will probably see a bit of a shift in which kind of stocks leads the market. it's very likely that tech will not outperform when interest rates are going up, but instead it'll be the likes of the good old-fashioned industries and the banks that will have a very, very good time. We don't think that equities as such will go down big time on this. There is a lot of fundamental strength in the economy. And ultimately, when we look back in time, that has been that one key factor, that one deciding factor on whether or not you get a good year or a bad period in the equity markets. That has been whether or not we are in the midst or in the early parts of a recession. You see it here with the shaded areas, and these are the places where equity markets really have done badly. There is nothing in any of our models, or even when we look at it from a qualitative standpoint, that makes us think that we are in the midst or in the beginning of a new recession. So we don't think, it's not our belief that markets will tank, will fall, drop, whatever you want to call it, in the near term or even in the medium term. But due to the fact that we are seeing this inflation kick up, and we are seeing the likelihood of increasing interest rates, and we are seeing the likelihood of tapering on the quantitative easing from central banks, we do believe that there is an increased chance that we will see more volatility during 2022, and that this will bring out probably some buying opportunities. In fact, I mean, the whole mantra that we've gone through for the last 10 years have been, you need to buy the dip. Every time the markets were down 5 to 10%, you had to go in and buy because that was what you needed to do, and it was a great trading strategy. That probably won't change. You will probably just see more of these dips. At least that is our best or our most realistic case right now. Equity markets will have a good 2022. It will be up, but it'll be more volatile. And like I said, I think one of the real triggers that will come and we'll see in 2022 will be this rotation, that the banks, financials, industries will do better than the techs for the first time in a very, very long time. So basically, we're at the end. So what is the key messages that we're trying to get out of this first webinar, this first short webinar, is that, well, 2021 was a great year for investors. The vaccines went out. We had tons of money being pumped out in the fiscal system and in the monetary system. If you're an FWU investor, well, you did even better again. We outperformed all of our benchmarks. We did exceptionally well towards all of our peer groups, and we did it with a very low volatility. But going into 2022, we are seeing a more fragile environment. We are seeing the risk of a more volatile environment, and maybe even of kind of a big rotation that is coming inside of the equity markets. Something that can really truly be quite interesting if you are looking to figure out where do you want to invest your money during next year. Very good. We end as we started, with a legal disclaimer that, of course, this is our opinions. Doesn't mean that they are guaranteed and that you should necessarily go buy on it. Good. Thank you all so very much for joining this first investment webinar, where we went through how 2021 was in terms of the equity markets, how they were in terms of our FW products.